Question 20. What is question 20 about? Okay, so it is about calculate the valuation and yield to maturity to Toltuck company's $100 bond under its old and new credit rating. So this is about how to calculate credit ratings and then based on that to value old and new bond valuation. So calculate valuation yield to maturity of this under old and new credit ratings. 10 marks. Coming to part B. Discuss the factors which may have affected the credit rating of Tolta published by the credit agency. This question is very common. You can take the answers. Okay. Factors which affects credit rating. C. Discuss the impact of fall in Tolta company's credit rating on its ability to raise financial capital and on its shareholder return. So what happens when the credit rating falls? What happens to the ability to raising financial capital and also on the shareholders return? Now let's go to this. Toltec is a listed company in the building industry which specializes in the construction of large commercial and residential developments. Toltec has been profitable for many years but has just incurred major losses in the last two developments which it has completed in its home country of Aramland. These developments were out of town retail center and a major residential development. Toltec company's director have blamed the poor results primarily on the recent recession in the country, although demand for the residential development also appears to have been adversely affected by it being located in an area which has suffered serious flooding over the last 2 years. Now we all know that when a country or when location, an area suffers from all this flooding and all, in that area, the demand for residential development will get hit. As a result of the returns from these two major developments, being much lower than expected, Toltex has had to finance the current work in progress by a significantly greater amount of debt. How are they financing? By debt finance, giving it a higher gearing than most other construction companies operating in Ireland. Toltex directors have recently been alarmed by a major credit agency's decision to downgrade Toltex credit rating from AA to BBB. Downgrade. We all know that credit rating can go up or go down or it can remain same, but it has an impact. It will have an impact on the company, the credit rating. Okay. Now the directors are very concerned about the impact this will have on the valuation of Toltax bond and the future cost of debt. Your bond valuation will change because of a credit rating change. So here it is going from AA to BBB. That's why that means it's not a good sign. Then your value of the bond will reduce and future cost of debt will increase. Now, the following information can be used to assess the consequences of the change in the credit rating. Now, from here itself, you need all the figures and all. Toltec has issued an 8% bond which has a face or a nominal value of 100 and a premium of 2% on redemption in 3 years' time. The coupon on the bond is payable on annual basis. 8% bond, nominal value 100, premium of 2% on redemption in 3 years' time. Right, coupon is payable annually. Government of Ireland has 3 bonds in issue. They all have a face or nominal value of 100. And all are redeemable at par. That means it's a redeemable bond. So this should tell you something, right? In the question, it always gives you a hint whether a bond is redeemable or irredeemable bond. Irredeemable, we don't get much. We always get redeemable bond because those has lots of calculations to do, right? So this is a redeemable bond, and all are redeemable and all have a face value of 100. Taxation can be ignored on government bonds. They are of the same risk class and the coupon on each is payable on an annual basis, right? So it looks simple that coupon is payable annually for each and also it is in the same risk class. Details on the bonds are as follows. So you can see you have been given the 3 bonds and redeemable, the coupon and the current market value. Then you have the credit spread for AA and BBB for each of the 3 years, which are published by credit agencies. These are shown in the basis point. Now coming to the last para. Toltuck's company shareholder base can be divided broadly into 2 groups. The majority of shareholders are comfortable with investing in a company where dividends in some years will be high, but there will be low or no dividends in the other years because of the cash demands facing the business. However, a minority of shareholders would like Toltuck to achieve at least a minimum dividend each year and are concerned about the company undertaking investments which they regard as very speculative. Shareholders from both groups have expressed some concerns to the board about the impact of the fall in the credit rating on their investment. So when you have to talk about that fall in credit rating, you have to use this paragraph, the dividends, right, about the majority shareholders and minority shareholders, how they express their views about dividend payment. You can use this piece of information for that requirement. So coming to the first requirement where you have to calculate the value of the bond. Okay, calculate the valuation and yield to maturity. Yield to maturity also you have to calculate, and the bond for under new and old. That means when it was double A and then when it was triple B. So starting from the government yield curve can be estimated from the data available. Right? We have to find what? The yield to maturity. Before we value the bond, we have to find the yield to maturity. How do you find the yield to maturity? How do you find the yield to maturity? Because without that, if you don't find yield to maturity, by the way, you cannot find the valuation of the bond also. Okay, so first it's like this: bond 1, bond 2, bond 3. Okay, so bond 1, you can see what is the value of the bond. It is 104 current market value, right? 104. So here we are taking 104 equal to 109 divided by 1 plus r, right? So basically we are finding this rate. This rate itself we don't know. What is that rate? Because that rate we need. Because that rate will change when the credit ratings reduce. So that rate we need to find first. For all the three bonds, that rate has to be same only. Not same, it will be different. So for bond 1, 109, 1 plus r. Why 109? How 109? Because the face value is 100 plus that 9% coupon. So it's 109. Here it will be 107 because face value for each is 100 and plus that coupon. So 107, and here it will be 100 and 100 plus 6, 106. Right? So that's why it is 101 divided by 1 plus r is equals to 104. So if you want to find this r, just make r1 the subject. So then it will be 109 divided by 104 minus 1. So you are getting r1. Exactly for year 1 you are taking this rate here. Same likewise for the second one also. Second one, the bond value is 102, this one. Current market value, right? On the right side of the equation, it has to be the current market. That's how we find, right? So current market value divided by is equal to what? Because this is bond 1. Only for bond 1 is only for 1 year. That's why we can just take 100 plus 9. 109. But when you come to the second year, be careful. It is not 107 divided by 1 plus r this time. It is for 2 years. So for the first year, you will only pay the coupon. That is just 7%. From second year onwards, you have to pay the interest, the coupon, and the face value, which is 100. So that's why if you see in the first year, right, the bond is for 2 years. So it is 7 divided by 1.048. What is this 1.048? It is exactly the rate taken from this because this is for year 1 only. So for year 1, you can take that rate. 7 because coupon is 7. Because you are paying coupon and the principal and the coupon for the second year. And plus, from plus, the other part is the second year. That's why it is 100 plus 7, 107 divided by, look at this, it is changing. 1 plus r square to the power of 2 because this is for second 2 years. Bond 2 is for 2 years. It is renewable in 2 years time. So now you have to make r square the equation, the subject of the equation, to find that because the rate will be different for the second year. So, right, this is how it is changed. Basically, okay, let me show you this equation. It looks a little complicated like this. Okay, so here it is, I'm writing from here, 102 equal to, okay, 7 divided by 1.0481 for the first year, plus for the second year it will be 107 divided by, I don't know the rate for the second year. We have to find out. Okay, so now if I have to make R2 the equation, how would I do that? How would I do that? This requires maths, application of your maths, not AFM. Now, if I have to make R2, here they didn't show you step by step. Directly they have taken R2 equal to this one, right? But when you do, you have to do step by step. Otherwise, directly you cannot come like that, right? You need some time. So bring on the equation side, bring 1 plus R2. Okay. Which is, wait a minute. I'm also doing this equation right now with you. Okay, so this part of the equation, okay, this part of the equation you can solve it because it is numbers only. It will be 6.68, right? Round up to 2 decimal places, so it will be 2. So we'll bring it this side. Okay, we'll bring this on the other side of the equation, so it will be 102 minus, what is 7 divided by 1.0481? 6.68 equal to 107 divided by 1 plus r to the power 2. Now bring this on the other side. Okay, so it will be 1 plus r squared to the power 2 equal to, just bring this the other side, so it will be 102 minus 6.68. Now r squared, if I have to find r squared, 1 plus, I will remove the square root. Okay, so that means it will be, this is 1. Okay, 1 plus r squared, it will be square root of 102 minus 6.68. Can you see in the equation here? Where is it? Here they have given it to the power of half. To the power of half means square root. And finally, just if you want to find R2, it will be 107 to the power of 102 minus 6.68 minus 1. You will get R2 as 5.95%. Just check yourself, are you getting it, right? So same step for similar step for step 3 also. Step 3 will be a bit more of it, right? Because we have for 3 years. So that means if you go to bond 3, just see here it's for 3 years. So first year 6%, second year 6%, third year 106 coupon and the principal amount, which is 100. So if you see first year we have already found, okay, this is the value 98. How 98? Because this 98, the current market value. So it will be 6 divided by the first year, which is 1.0481. We have calculated for the bond 1. For second also now we can use 5.95% for the second year. 6 divided by this. Third year it will be 106 divided by 1 plus R3 to the power of 3, because for 3 years. Now we have to find R3. So same way, make R3 the subject how we did for R2, and you will get R3 as this. Now this time it is 1 to the power 3 if you see. Cube root. Cube root. Okay. And you are getting 6.83. Exactly you are using those. This is for the second and this is for the third year. Now what is the old rating? Spread old rating. With this rates, government yield curve, whatever the rate you got, yield to maturity, you have to add. You have to add your ratings. That's why we have to find this ratings first. This one, this one, this one. For this one, to get this figure, you have to know this working. This working you have to know. So old rating was which was under double A. It is 18 for the first year, 31 for the second, 45. That means 0.18. It is in basis point. So 0.1 is 0.31, 0.45. Add it. So this will be your this 4.99, 6.26 and 7.28 will be your old rating. Now come to your new rating. What is your new rating? It is under triple B, 54, 69, 86. If you see, you are having more ratings for the triple B. Higher ratings compared to double A. Okay. So you are adding that 0.54. With what are you adding 0.54? Hmm? Hold on. The mistake you all do is what do? You start adding this like this. Let me show you here. 4.99 plus 0.54. It's wrong. You are not adding it after you added old rating. You are adding this 0.54, the new rating with this 4.81. So it will be 4.81 plus 0.54. With the yield which you have calculated, you are adding the new rate and the old rate to compare. And you are getting this, this and this. Make sure you get these answers. Now, valuation of bond under old credit rating, put a subheading like this. What bond you are calculating? Under what? When we see your answers, we have to be able to differentiate which one is the old, which one is the new. Because we are valuing the bond using the two credit ratings, old and new. So you have to write a subheading. Now first we have to find for old credit ratings. And this is the valuation of bond on the new credit rating. Forget about new credit rating. I'm covering it up. Don't see the new one. Just focus on the old one. How are you getting that old credit rating? How are you getting it? Old means under double B. Okay, so you have to start exactly, you have to write like this. Whenever you have to write a value of a bond, you have to write year, payment, and then discount factor and discounted cash flow. So discount factor is easy. How are you getting discount factor? Like this. When it comes to second year, it will be this. Squared. Don't forget to square it. For third year, it's this, because this is under old. Right? Exactly, you are just 1 divided by the rate. That will be your discount factor. But what about this payment? If you see 88 and 110, right? And when you multiply with the payment, the discount factor you add, you are getting a bond valuation of 103.8. But the thing is, how did you get this payment 88 and 110? Because just go here. Toltuck has issued an 8% bond. So it will be 8 and 8. But what about the third year, which has a face on a nominal value and a premium of 2%. Premium of 2% on the redemption in 3 years' time. On the redemption in 3 years' time is the third year, they are going to have a premium. That's why it was 8 and not 108. 108 plus 2% premium. That's why it was 110. So 110. Now coming to the, so now you see one thing before I go to the new credit rating. Just see one thing where you can go wrong when you calculate this rates here. The first one, bond 2, bond 3, bond 3. If you calculate the rates wrong, what could go wrong? Your old rating will go wrong, your new rating will go wrong, your discount factor, because those rates are also dependent. Based on those rates only you are going to calculate your discount factor, your discount factor will go wrong. If your discount factor go wrong, discounted cash flow goes wrong, then your valuation itself goes wrong, everything goes wrong, everything is followed up. So make sure that you are very correct in this first step, because if you are correct in your first step, there is unlikely any chance that you can go wrong at the end. Most of the mistakes are done in your first steps only, first working only, because that is more critical and it has more workings. After that, rest all, it's easy, it becomes easier. You just have to pick up the numbers from there and calculate. That's it. So make sure that in the first step itself you are very correct. Now coming to the credit rating, same for the new credit rating. How are you going to do it? But there is a problem with the new credit rating. Okay, we'll see that. So first, from year 0, then 1 to 3, then 3. If you see year 0, we are paying 103.8. How did you get this 103.8 and its bracket? Because it is this. Yield to maturity. See, we need yield to maturity under all credit rating. Why is that? Because the question asked valuation and yield to maturity. So first you have to find yield to maturity under old credit rating and then yield to maturity under new credit rating. So yield to maturity under old held rating. First you have to calculate the value of the bond, right? Oh, before going to this one, sorry, I missed one part here. I missed this, which is very important. Valuation of bond under new credit. Okay, so before the question asked valuation and yield to maturity. Before calculating yield to maturity, you have to calculate valuation. So valuation for old credit rating we found 103.8. Okay. Now for new, it is the same 1, 2, 3. Payment will be 8810 because same bond. It's just the discount factor will be different. If you see this discount factor is this. From where are we taking this discount factor? From this. These are the values. Don't forget to square the second years and to the power of 3 for the third year, right? This is square and this is to the power 3. Then discounted cash flow 102.7. Just see what happened to the bond. What happened to the bond valuation? Went down because the credit ratings declined. It downgraded from AA to BBB. This is what happens when your credit rating goes down. Your bond valuation will reduce. Now coming to yield to maturity. So bond valuation part is over. Yield to maturity under all credit rating. So yield to maturity is you are finding a rate. Okay, it's like you're finding cost of capital. So this is how you start. Whenever you have to find yield to maturity, YTM. Okay, make sure that you exactly make this table. The reason I'm putting this in a table is for you to better remember it. So you're starting with year 0 and then 1, 2, 3 and the third year. So 0 will be this. This is all this I have explained before also. I think when I was discussing valuation of bond and all, you can check those videos also before videos. It will be in my investment appraisal lecture only, that playlist. So 103.8, this bond valuation, you are taking it here. Your bond valuation will come in year 0 all the time and it will be in bracket. Because now you're finding cost of capital. It's like you're finding yield of maturity is very similar to cost of capital only. 1 to 3, 8. 1 to 3, it will be your coupon only, 8. Third, it will be 102. How 102? Why is it 102? 110 minus 8. See here. It is 110. Okay. Minus 8 because coupon you're already paying for the first 3 years. So in the third year, with this coupons, okay, 1 to 3 already includes your coupon. So in the third year, again, you are not putting your coupon here. You are just putting your principal amount. That is 102. Usually it is 100, the face value, but here we have 2% premium, that's why it's 102. Right? We are not including that coupon 8 because that coupon 8 is included here already from 1 to 3. So that's why in the 3 only the principal amount, which is 102. Okay. Next, discount factor 8%, right? Because 8% bond. So first discount yield to maturity, when you have to find, remember you have to use IRR. So you have to know how to use IRR also. If you're not good in that, you cannot find yield to maturity, right? So first discount factor will always be given to you. Second, lower or higher will you decided on based on the value you are getting. If it's negative, you have to use a lower. Okay. So here if you see discounted cash flow, okay, once you discount, you are getting a negative minus 2.19. Okay. So now we are using a what? We have to use a lower discount factor because we are getting negative figure here. That you have to decide whether higher than 8% or lower than 8%. Right? If it's a positive number, higher than 8%. If it's a lower number, negative number, less than 8%. So we are using the next one, 7%. Now that rate, what should be the rate? What should be the second rate? It can be any rate. It can be 5%, it can be 4%. More than 0%, not 0%, okay? 1%, 2%, 3%, 4%, 5%, 6%, 7%. Could be anything. It is better to take the next lower number. That means 7%. Because when you calculate also the difference is 1, 8 and 7. So it's easier for you to calculate. For your calculation purpose also, taking the next lower number is better. So after you discount, you are finding a positive. So now you can use an IRR approach, yield to maturity. This is the formula for IRR, right? 7%, 7 is the lower discount plus the, using 7%, your value was 0.42. Divide by the difference between these two. Okay, since both are negative, so it will be added. Then into the difference 8 and 7, so it's 1. So it is 7.16. Of course, with 8%, if you are getting negative and 7% you are getting a positive, means percentage will be somewhere in between 7 and 8, right? Now coming for the new credit rating. So new credit rating, bond value using the new year, this one, 102.7. It is the valuation of bond under new credit rating. So that will be 4 years 0. Same way how we did for old credit rating. Here it will be 8 only. Here it will be 102. There will be no change in that. Discount factor is 8 only. And when you found discounted cash flow, here you are getting a negative, means you have to use a lower number. So here also we are using 7%. And using 7% we are getting a positive. That means the discount factor will be somewhere in between 7 and 8. Okay. So using IRR, we are getting 7.58%. Okay. Now you need to comment on what's happening. So the market value of 100 bond has fallen by 1.1 and the yield to maturity has risen by 0.42%. Has fallen by 1, yield to maturity has risen. So bond value fell down because of that change in credit rating. You have to say this. What happened to the market value of $100 bond? It fell down. The difference you have to say. And what happened to the yield to maturity? It increased. It rise. That means cost of capital increased basically, which is not good. Yield to mature. So the bond value was before in old credit rating is what 103.8. Okay, in the new it was minus. What is the new? 102.70. What is the difference? 1.1 only. Fell down. Now coming to IR yield to maturity, 7.58 for the new, and for the new old it was 7.16. What is the change? 42%, 0.42%. It increased. This statement has to be there. Now coming to part B. Part B and C, It is easier, it is just theory part, so quickly I can go. Okay, so credit rating will have taken the following criteria into consideration when assessing. See, credit agency, whenever we all know that credit agency gives our company some credit ratings. They just don't give that credit ratings. There are some criteria for them. So basically, what are those criteria? Those are the things which you need to list and talk about. Based on what are they giving us credit ratings? So these are some few things to consider: country, industry, okay, management. This all are taken from textbook. Just go through this answer. You can even copy paste also. Not everything, not line by line, but at least you can understand it and write in your own words in the exam. Okay. If you want, I can go through this. Let us go. Will not take so much of time. But with the main question, I'm over. So country. Toltuck's debt would now normally be rated higher than the credit ratings of its country of origin. Exactly. Your debt will never be rated higher than the credit ratings of the country. Remember that. RM land. You have to mention about this since we talked about country. What was the mark? 1, 2, 3, 4. There are more points to this. Okay. How stable is your financial position? How stable are your earnings? All those things you have to talk about. But what is the marks here? We have to see the marks. It was just for 8 marks. So that means 4 points. You explain, you are getting 2 points for each. So 4 points is more than enough. Therefore, the credit rating of farmland should normally be at least AA. At least. The rating will also have dependent on the Tata standard relating to other companies in the farmland. Right? How is your company compared to other companies in that country? That rating is also based on that also. The credit agency may have reckoned that Toltuck's recent poor results have weakened its position. We saw that the position was weakening. So because of that poor results, maybe they thought that their credit rating should have reduced. So going to the second point, industry. The credit agency, and all this are very important by the way, because you might be asked a theory question on this. So if the same question is asked, at least you can give this point. So it's always better to go through these questions and never to ignore this. Coming to industry part, the credit agency will have taken account of the impact of the recession on property construction was given, right? So we saw that there's a recession on that industry, even the companies in that industry only, property construction company. So the company's position within the industry compared with competitors will have also been assessed, right? If similar recent developments by competitors have been more successful, this is likely to have an adverse impact on Toltuck's rating. If your competitor is performing well in that sector in the times of recession, then your credit ratings will suffer. Coming to management part. Okay. The credit agency will have made an overall assessment of management and succession planning. It will have looked at business and financial strategies and planning and controls. It will also have assessed how successful the management has been in terms of delivering financial results. The credit agency may have believed the poor returns on recent development show shortcomings in management decision-making process, and it may have rated the current management team poorly. Maybe the management is not doing so great in the company. Maybe because of that results are poor. So it is the lack of management's performance. So that is one way why the credit rating went down. That is how a credit agency might rate the company, right? All these are simple, and in finance, if you see, it's so many things. We don't have to write so many of things. Okay. First of all, this is just for your understanding, for your explanation, so that you understand better and learn more points. Okay. Otherwise, in the exam condition, you cannot write this much. Come on, it's not possible. You just have to write 2 point. You have to write 2 points maybe for each point. Under each point, you have to explain. So just 2 or 3 lines is enough. You cannot write all this. But at least you can read and understand it so that in the exam writing in your own words becomes more easier. Credit agency will have analyzed financial results. Financial results they will analyze using measures such as return on capital employed. Agency will have also assessed possible source of future earnings growth, right? How stable your earnings are. What is the growth of your future earning? Is there any growth, or are your earnings going to decline? The credit agency will see all these things. It may have been skeptical about prospects, certainly for the short time given Toltuck's recent problems. So if a company is currently facing problem, then credit agencies become very skeptical about their decision before they give you any credit ratings, right? It is their job. It is their job. They have to be skeptical. Because what if your company, after they give you good credit ratings, because see, based on the credit ratings which agency company gives your company, other stakeholders or shareholders are going to invest in your company. The debt holders are going to provide you finance. What if your company in 1 month has to file a bankruptcy or has to go for a liquidation? Then whose fault it is? The fall will come on the credit agency because they are the one who gave them good ratings. So all those factors, how they manage, what are their financial results currently in the short term, how they perform, what is their future growth, all has to be considered before a rating before a rating is given. Coming to the second part, the credit agency will have also assess financial position, looking at its gearing and working capital management. So all this time, when you're talking about financial, you have to talk about financial part. Gearing, number one. Working capital management. Are they enough to pay back their creditors? Do they have current assets more than liabilities? What is their gearing? Is it too high? Are they too risky? Are they able to pay their interest on time for the loans they have taken? All this has to be considered. And considering whether Toltec has enough cash to finance his needs, agency will also have looked at Toltec's relation with his bankers and his debt covenant to assess how flexible his source of finance are if it comes under stress. It may well have been worried about Toltec's gearing being higher than the industry average and concerned about high level of cash it needs to finance corporations. It will also assess returns on development in progress compared with commitments to repay loans. Greater doubt. See, all this they are talking about loan. You don't have to explain so much of points. Okay. Greater doubt about Toltec's ability to meet his commitment is likely to have been a significant factor in the fall in his rating. So here is the reason they are giving that why that rating fell from AA to triple B. One could be that they are having difficulty in meeting their commitments to pay back their debt. Now, the agency will have also needed reassurance about the quality of the financial information it was using. So it will have been looked at the audit report and accounting policies. Maybe they will be looking the audit report and all. So that's it. And coming to part C. What was part C about? Next question is 21. Yes, that's why it's here. We'll be discussing this as that will be my next video. Question 21. Okay, so 23. Discuss the impact of fall in the credit rating on its ability to raise financial capital and on shareholders' return. Very important point. See, one thing when you're studying this bond valuation and credit ratings, when you study a topic, let's say this topic is about bond valuation and credit ratings. So when you study this, always learn all the theory parts, all the maximum questions or theory questions that can be asked from this topic. See, calculation part we know, but I'm talking about the theory part, like this type of question, how it is going to have an impact on the shareholders return or the ability to borrow. So this is just one way of questioning or one type of question on this under this topic. There could be so many other questions, so please go through those questions, group them in one and study them and see the pattern. That's how you learn. Put it in one, you study segment by segment. Even questions also put in one group, classify them into different groups. Every question is not same. See that pattern. If it's bond, so under bond, whatever the theory questions, collect them, keep in one place, start doing them one after the other, one after the other, one after the other, until you have finished all the questions in bond valuation. Let's say for example, don't go to other question, don't jump to risk management. That is a different portion. So you study segment by segment, portion by portion, until you get so better in that topic, right? That syllabus, that part of the syllabus. Don't go to the next, right? Because when you have this, when you make this timetable also, we allot time, maybe 1 week or 2 weeks for risk management, and then investment appraisal, then for reconstruction. So whatever the time you have allocated for that area, fully study that area only and get mastered at that. Don't jump into the others, because we have this tendency, we just want to finish the syllabus at whatever cost as soon as possible, but we don't care about the quality of our studying. We just focus on how much we are studying, how long we are studying, and how many questions we are doing. See, you can do 100 questions also, and another candidate just have done 40 or 50 questions, but he or she passed and you didn't pass. So then you'll be feeling bad that I have done 100 questions, I should be knowing more why I failed and why my friend passed just by having 30, 40 questions. The reason is the person who is doing questions, it does not matter how many questions you do. Number of questions doesn't matter. You can do 20, 10 questions and pass the paper. What matters is once you, how you're understanding the concept. uh, the quality matters a lot, right? The breadth, the depth of that. Maybe that person is doing 10 questions, but he has a very deep knowledge in that area. He has a depth. He knows questions from various angles. He knows how to tackle questions from various angles. It can come from anywhere. He doesn't get scared. Maybe you have done 100 questions, but you are still not confident. So that's the one major reason, the difference between your pass and failure. So don't be in a hurry to complete questions. You can go slow. Slow and steady wins the race. Remember that. Same for ACC also. Slow and steady wins the race. The faster you try to go, you will panic. You will not focus on the quality. You will just focus on finishing that question at whatever cost. You are not learning anything. Okay. So that is my tip for the day. Bonus tip. I always give some other few tips I'll be giving. Whatever I remember on the spot I give because later I might forget. So now coming to part C. Okay. Part C is also quite a lengthy, but I really have to go through this because then I have to explain it also. So Toltuck may not have increased problems or raising, okay, may not have increased problems raising debt finance if debt holders do not react in the same way as their credit rating agency. So what is the first point saying? The first point is saying, see, it is not necessary that your credit ratings reduced, the finance debt holders will also react in that way. Maybe they will not give you that much debt or not. No, maybe they are not reacting so much to that credit that the ratings. It's just possible. So if they don't react in the same way as the credit rating agency, then there won't be much problem for the company. They may attach different weightings to the criteria which they use. They may also come to different judgments about the quality of the management and financial stability. See, no two-person might have the same view, right? The credit rating reduced from double A to triple B. For some, it might be good. Some might be thinking it's not much different. Some might be thinking it's very bad. So it is the same situation only. Credit ratings reduced, but different people might have different opinion. So it is based on their judgments, how they view the quality of management, how they view the financial stability. Debt holders may believe that the reason problems Toltec has had generating returns may be due more to external factors which its management may could not have controlled. See the reason problem. If you see the reason problem in Toltec, what are the reason problems? It faced a recession for 2 years. The demand for the residential property reduced. Why is that? Because it is because of flooding and all in that location. So is it the fault of management? Can management control that factor, flood and all? There's a external reasons. See, there are so many reasons a company is not performing well, and most of them in this case are external, which are beyond the manager's control. So maybe due to that, the debt holders may not take that decline in credit ratings so seriously because they know these are external factors. So it has nothing to do with the company's performance and all. Coming to second para. However, it is probable that a fall in the okay Tata's credit rating will result in it having more difficulty raising debt finance. It is probable. On the one hand, you are saying that it might not be a problem. On the other side, you are saying it might be a problem. You have to bring both the sides. Okay. Because it is for 7 marks. 7 marks are just not given like that. You have to tell both the sides. That's why the question, even the word, look at the wordings. It is probable. They didn't say it will be or it has to have. It has to have. No. Or it should be, it must be. No. They are not giving, they are not asserting it. They're just saying it is probable. It could be, right? That the fall in credit rating will result in having more difficulty raising debt finance. How? Banks may be less willing to provide loans and investors less willing to subscribe for bonds. Even if debt finance is available, it may come with covenant restricting further debt or gearing levels. This will mean that if Toltuck requires substantial additional finance, it will be more likely to make a right issue or issue new equity on the stock market. This is very beautiful. See, all this point which is there requires you to think more, think in depth. Critical thinking is required in this type of question. Your textbook knowledge or this case study will not help you. There are some things beyond the case study. You have to look the factors. For example, nowhere in the case study they told that they will have issued a right issue or they might have issued new equity. Nowhere in the textbook it is written that when this condition comes, you have to do this. Then how are you writing these points? These are your critical thinking. You need to be creative. You cannot be like a, what do I say? You are not a robot, right? You follow instructions. Some structures are given to you. Exactly follow that. Every situation is different. Every situation has to be dealt in a different way, right? So this is one such question. That's why I'm taking you through this question to show you the depth of this question. From from what angles they can bring points here, and from what angles you need to consider points when you have to write on this question or on similar type of question like this. And mind you, it's for 7 marks, right? So see, it is very simple. It's not just so hard. If debt finance is not available, or if you require us additional debt finance, right? Then you have to talk about other sources of finance, right? What are those sources of finance? They are more likely to have right issue or issue new equity because they're listed company. So they can go for issuing new equity or right issue on the stock market. Remember, they are listed company. If the same point, if you're writing for a company, let's say in your exam you got a company which is private company which is not listed on the stock exchange and you're making this point, then you are absolutely wrong. So that's why I tell you, don't be like a robot. You cannot copy paste everything. You cannot apply everything what you have learned. There are something where you have to have a creative thinking. See the question. This is a listed company. If it's unlisted, this thing will not apply. You cannot issue new equity shares on unlisted company. Maybe when you are doing mocks of past papers, you might have studied this thing that issue, right issue, or may issue new equity. You have been studying this thing over and over again. What happens is when their times are come, okay, when there comes a time in your exam, you are given unlisted private company, and there you are writing the same point. Why? Because you have memorized it all over again. Issue right share. This is why I tell you that when you apply also, when you write papers, past papers, mocks, when you do, have that presence of mind. Don't always think what you have studied in the past. Ask this question from yourself: what I am writing, is it practical? Is it applicable for in this sense for this case study? Then you will get your answers. Then you know what are the points you have to make. If it does not, then don't write. It might have been right for some other question, but it's not right for this. So now right issue equity on stock market. Okay, now coming to the shareholders may be faced with the choice of subscribing large amounts of new capital or having their influence diluted. This may particularly worry the more cautious shareholders. Yes, you might say right issue, but there are problems with right issue also. Shareholders might not want to go for that because it will dilute their ownership, right? So they'll be more cautious for this. Now, even if Tolta can obtain the debt it needs, the predicted increase in yield to maturity. You can even give figures also. We have just calculated, I think from 6.18% to 6.7. Let us go and check. Yeah, 7.16 to 7.58. It increased. Yield to maturity may be matched, okay, by debt holders demanding a higher coupon rate on debt. So if the debt holders are demanding a higher coupon rate on debt, then this predicted yield to maturity will match. This will increase finance costs. Yes, they can increase higher coupon rate, but this will increase the coupon finance cost. No, you have to pay higher interest and decrease profit. Finance cost increase means profit decrease. Profit decrease means EPS also will decrease with a possible impact. See, you have to talk about all this profit and EPS because you have to talk to return to shareholders also. The question asked two things: your ability to raise finance and return to shareholders with a possible impact on share price. Share price will get impacted. It will also mean that fewer funds are available for paying dividends. Now you see, in the last paragraph we talked about dividends, where two, right, where they had different views about dividend. So Toltuck has been faced with difficult decisions on balancing investment expenditure versus paying dividends, and these difficulties may well increase. Additional debt may have other restrictive covenants. They may restrict Toltuck's buying and selling of assets or its investment strategy. Yes, you cannot invest as the way you want, because additional debt may have certain restrictive covenant which can even restrict your investment decision. If you want to invest in some plant and making, you cannot do it. So restrictions on Toltuck's decisions about the developments it undertakes may impact adversely on shareholders' return. Rather than just saying that this thing will impactly affect or have a negative impact on shareholders' return, you have to explain all those points. You have to talk about profit, EPS, dividend, share price, and all those things. Then you can say that it will have an impact adversely on shareholders' return. You just cannot write it will have an impact adversely impact on shareholders' return without explaining how. You have to show them. In the above paragraph, you exactly showed them. You told how debt will increase and then profit will decline and EPS will decline. All these things you talked, and then you said this statement. If you just said it will decline or it will have impact adversely, you will not get points. 7 marks. So you need to come up with points. Okay. Loan finance or bonds will also come with a repayment covenant. They may require Tolduck to build up a fund over time, which will be enough to redeem the debt at the end of his life. If you're taking a loan and a bond, it's always safe, secure to have some what do I say? Some fund build over, so that in the last moment, right, when you have to redeem the debt at the end of his life, you have enough cash to pay back, and after paying back, also you have enough cash left at hand, so that there is no problem in operation of your company. It runs smoothly. There is no cash shortage or anything like that. Given uncertainties over cash flows, this commitment to retain cash may make it more difficult to undertake major developments or pay an acceptable level of risk. So they are talking about levels and uncertainties about cash flow. It is given from the case study. The fall in Tata's credit rating may result. Now you see you are coming to the conclusion. Last paragraph is always about your conclusion only. You're summarizing basically the whatever you told before, you're summarizing now and giving in one paragraph. Okay. So fall in the company's credit rating may result in its cost of equity rising as well as the cost of debt. Cost of equity, cost of debt rising. Both are rising. In turn, Toltak's WACC will rise. So even its WACC will rise, because WACC is cost of equity plus cost of debt. If those both rise, WACC also will rise. This will affect his investment choices and hence his ability to generate wealth for shareholders. It may result in Toltak's priorities in developments offering better short-term returns. This may suit the more cautious shareholders, but the current majority may worry. So you have to talk about the minority shareholders and the majority shareholders. It is a sign of worry for the majority shareholders. Why? Because they want us, what do I say, a stable amount of dividend. But in this condition, it does not look possible. So the current majority may worry that Toltec will have to turn down opportunities which offer the possibility of high returns. They cannot give high returns. Majority shareholders, they worry about dividends, right? So Toltec will not be able to provide those. So that's it. We'll go to the marking scheme. Part C, 1 or 2 marks per impact discussed. Coming to part A, 2 marks for that till maturity. So just see, imagine there are so many workings for that 2 marks. If you get wrong somewhere, you will lose that 2 marks. Then comes Toltec spot curve old and new. Then comes bond valuation, 3 marks. Yield to maturity, 3 marks. Coming to part B, financial factors and other factors, 4 marks. Limit marks for part B to 3 in total if answer does not mention Toltec's position and performance. I always tell you mention the company's name, their position and performance. So that's it for this question. My next question will be question 21. I just have two more questions under section B, and then we are done. And then finally, I'll be starting with mergers and acquisition. I already started, but I just have, I think, four questions in that part. So that's it. Don't forget to subscribe, like, comment, and share with your friends. Thank you. Take care and stay good.